Yeah. Hi. So, yeah, sorry guys. So basically, corporate underwriting is the process of evaluating the financial viability and profitability of investment projects undertaken by a company. It helps companies make informed decisions by assessing the expected cash flow, risk, and potential returns of a project. Now, tell me, normally, because there are people who are from the credit and risk domain, what are the typical types of corporate underwritings? What are the different products you have seen in corporate underwriting till now? Just you can write in the chat box. Then accordingly, we can take the discussion ahead. Guys, please writing in the chat box. What are the typical types of corporate underwriting? What are the different types of corporate underwriting? And what you have seen? Can you write in the chat box, please? Working capital, okay, very good. Term loan underwriting, very good. Project finance, good. Syndicate loan, very good. IPO underwriting, yes. Next, it could be merger and acquisition finance, yes, structuring. Okay, very good. So here we are mainly focusing on project finance. So we will talk about NPV, IRR, and then we will do a bit of brainstorming about calculation of NPV and IRR. And we will talk something which is related to the project funding. Now, when we talk about NPV, it's basically the difference between the present value of the cash inflows and present value of the cash outflows, right? That's a theoretical concept. Yeah, NCD underwriting is there, best effort loans are there, right? Now, this is a typical formula of NPV, right? Cash outflow, cash inflow. So we can even do it in Excel. So when there is a cash outflow, of say 4 lakhs and cash inflow, say year 1, 2, 3, year 5, 4, and year 5 is say 85,000 per year. It may be uniform, it may not be uniform as well. Then how do I calculate NPV? How do I calculate NPV? To see whether the project is actually useful or not, right? Before that, I would like to know what do you understand by the concept of discounting? Do you have any idea about discounting? If not, I'm definitely going to explain. And if yes, then please write in the chat box. What is the discounting and why do we discount? Present value of future CFs. That's okay. But then why do we need to discount? No, outflows and inflows turns to nil IRR, not in NPV. So why do we need to discount? Correct, Praveen. You are absolutely right. To correctly assess the time value of money considering inflation. So what happens if I am getting 85,000 in year 2? What is the present value? See, definitely. So like I give an example. So I will give you 100 rupees. You have two options to choose from. One option is you take 100 rupees today and 100 rupees tomorrow. The another is you take 100 rupees tomorrow. Sorry, you take 50 rupees today and 50 rupees tomorrow. The second option is you take 100 rupees tomorrow. Which one will you choose? I give you 100 rupees. You have two options to choose from. You choose to take 100 rupees today, 100 rupees tomorrow. You choose to take, you choose to take 50 rupees today and 50 rupees tomorrow. And you choose to take 100 rupees tomorrow. So I write it like this. I have today, you take 50 rupees and tomorrow you take 50 rupees. The other option is tomorrow you take 100 rupees. So this is option 1. And this is option 2. Which one will you choose and why? Why? That is one part. Second, that is definitely one part. Immediate cash in that. That is true. Very good, Praveen. So 50 rupees today is more than 50 rupees tomorrow because of inflation. No, actually, eventually you have more than 100. No, eventually you have 100. But if you go for the second option, eventually you have less than 100. If you go for second option, eventually you have less than 100. You are getting amount which is lesser than 100. Because the commitment is done today, right now. If I get 50 rupees right now, 50 rupees tomorrow, the value will be more considering the time value of money. And tomorrow, if I take 100 rupees from you, then obviously it is going, the value of that 100 rupees is going to be lesser than the option 1, right? So similarly, 85,000 received on the 4th year is much lesser in value compared to 85,000 received today. So what do? I do discounting. So I discount the value with a certain percentage. Yeah, Kamlesh, theoretically, today and tomorrow will also make difference. Practically, it might not make too much of difference, but still it will make difference in the form of certain paisa, depending on the amount. So if it is 1 CR, think if today, now I am talking about 50. Now I am talking about 50 CR. Then one day can make a huge difference. Right? So the concept is applicable, might be even in some paisa, 1 paisa or 2 paisa, but there will be certain difference. Correct, Praveen. Like overnight deposits used by bank, at times you might see that your salary gets hold by 2 to 3 days, they use the interest. If salary of 500 people are getting stuck by even 2 days in a company, the company gets interest for that. It happens. They'll say because of error or something, whatever, or even the company asks them to remit the salary on 31st, the bank stating technical error, they remit on 2nd. We get stressed because we have EMI to pay on 1st. Yes, Taruma, right? Overnight mutual funds. So it's a matter of a day which also has some value, right? So what we do is we do discount. Now, when we talk about discounting, this formula is applicable. So it is the cash flow divided by 1 plus discount rate to the power year. This is the formula. 1 plus discount rate to the power year, right? Now, say I consider a discount rate of 5%. Can you find out what is the NPV here? Find out what is the NPV. Or find out what is the discounted. First step is find out what is the discounted cash outflow. Discounted cash outflow, sorry, inflow. And then you find the net present value. Please do this. Please do this exercise right now, considering the discounting rate as 5%. I'll give you 10 minutes. 10 minutes for this. Please do this. And write your answer in the chat box. Yes, present value for the whole cash flow year 1 to year 5, and then the net present value. Ishwan, don't use Excel formula. Even I can do that. I can easily calculate using I equals to NPV. Now you give me what is the present value of the third year? What is the present value for second year? I need each and every one. Don't do this, boss. Check when you are writing NPV is negative, just let me know what is the PV for year 1 and year 2. PV year 1, 2, 3, 4, 5. I need this. Tell me. Year 1 is yeah. Year 1 is 80,952.38. Correct. So year 5 is 66,599.72. So it is okay, 77097.50, 73426. I'm believing you have done it correctly. 19 and then 69,929.71. What about fifth year? 66,599.72. Right? Now we see the sum. 368. Correct, NPV is negative. Otherwise, what was coming? 4,25,000. So what is the future value is 4,25,000. The present value coming is 3,68,000. So basically, the concept of discounting is nothing but we used to do something called compound interest in our school days. We just reverse it. We just reverse the concept of compound interest. So we go backward. So there in compound interest, you go forward, right? Because the principal, so what we do, say I'm investing 1,000 rupees into, so what I do, suppose my principal is 1,000. ROI is 5%. So I'll write rather 0.05. 0.5. And my tenor is 5 years. Right. So what is my amount? My amount is 1 to the power. This is my amount, right? This is going to be my amount. Now in discounting, this is just the reverse. So I know my amount. I have to find out the principal. So I reverse it. That is the present value of my money by discounting. Yes, Rajesh, what is your doubt? Please tell me. What is the meaning means? I didn't get it. What is your doubt? May I know your doubt exactly? How to interpret, what to interpret? It is discounted cash flow we are taking out. So discounted cash flow means in a project, you have estimated there will be cash flow of 85,000 in the year 1, year 2, year 3, year 4, year 5. So it might not be equal. It could be 85,000 in some year. It could be 90,000 in some year. This is just an example. Now, what is my net present value from the project? Yes, amount divided by 1 plus discount rate to the power of number of years. 1 plus discount rate, not discount rate, Tarumai. It is 1 plus discount rate. Look at this place. Okay. So this is the concept of NPV when we talk about NPV. Now, what we are going to do is the entire cash present value of cash inflow is 3,68,005.50. What is my cash outflow? It is 4 lakh. So it is actually negative. Ideally, my PV of cash inflow minus my cash outflow. This has to be positive to choose a project. If it is negative means I'm running into a loss. So here it is negative. This minus this. So it's negative by 31,994.50. It's negative. So I choose the project? Do I choose the project? That is my next question to you guys. So it's a generic answer. No. But think in a critical way. Do I choose the project? So if you increase the discount rate, then there is more loss. Yes, logically, at a first glance, I do not choose the project. I discard the idea of choosing the project because there is a loss. NPV is negative. But can I do something by which I can choose the project? See, you are into credit underwriting. We are not doing a problem. We are not solving a problem of graduation or MBA, right? If we do that, then easily we will say that we will not take up the projects. Now, I have to take up the projects. How can I mitigate? Yes, Yashwat, reduce the outflow or discount rate or both. But discount rate, ideally, you should not reduce because of something which is based on the inflation, where you don't have much control. Yes, Bharat, that could be one suggestion. So as a consultative mode, you can suggest the customer some ways by which he can increase the inflows in the initial years. What else? Think yourself as a consultant. Yeah, I know there is NPV negative, but how do I justify that and take up the project and get this project funded? Well, collateral is one part because collateral you have to recover, sell it, and like you are going into a loss-making project and mitigating with your collateral, which doesn't make much sense because it is a loss-making project as per the as per the entire calculation. So somebody will ask you why you are getting into it, and then again to recover it from the collateral. Why do you get into a business where you need to recover collateral? Arvind Sharma, I am very much with you. Outflow control is something very important. So where from this 4 lakhs is coming? Tell me. Why I am coming to this? How come I am coming to this figure 4 lakhs? Cost of the project. Now, what is the cost? What is cost of the project? What are the components of that? How a project estimation is done? Correct, fixed working capital. And how a project estimation is done? How a project cost estimation is done? No. Investment is something, I'm talking about the project viability overall, right? Even if you put 100% of the investment, that will not make the project viable. Rather, from the investment, when you are raising investment, you are taking more liability. Yeah, planning of expenditure is one thing. But how do I structure the components in such a way that my project cost is minimized? So just tell me anybody from credit underwriting who has done project financing and any practical example where you have done a project, you have funded a project. Okay. Okay, understood. Not an issue. Let's discuss this. So suppose I am estimating project estimation, right? So what are the fixed components? Fixed components. Say I am putting a factory. The first one is land, right? Second one is construction cost for building and shed. Next is plant and machinery. Next is equipments. I'm coming to that. Raw materials doesn't come in the fixed cost. So I'm talking about fixed components. Yeah. Okay. So these are some of the fixed components. Coming to the variable components. Components which can have, one is raw material, second is manpower. Now in manpower, skilled. When I talk about skilled, it means technical. Technical could be functional technical or technical technical. Functional technical means accounts, human resource, etc. And technical technical means the engineers and all. And there is unskilled. Right? Now this is a capex, say something around 100, 200, 350. Now this is a capex. Which one time, what is happening here? Okay. Which at a time I have to shell out, right? These figures are arbitrary, just for example. Coming to estimation of raw materials, how do I estimate how much raw material I need to procure or how much fund I need to keep for the raw material? How much fund I need to keep for the raw material? How do I understand this? How do I estimate how much raw material I need to procure? So when you talk about daily manufacturing capacity, my machine is having 100,000 units of capacity, right? Per day, 1,000 units per day. Does it mean that I will procure raw materials to produce 1,000 units? Slight critical thinking, boss. NPV negative, I will discuss the project understood. Everybody knows, even a graduate knows. But when we are professionals, we have to be more critical in our thought process and give a solution to a problem. Yes, Kamlesh, we'll look at the sales and the credit period, right? So what happens? My there are multiple things. It is not only sales. One is sales, my economic order quantity level, inventory valuation by doing FIFO, understood, but that is not the way I estimate my raw material. When I estimate my raw material cost, first of all, I will look at last few months sales. Actually, that is also wrong. Is it a correct way to see only last few months sale? This is again my question. From the business angle, is it right to look at last few months sales only? Why no? Yes, could be cyclical business. Could be a cyclical business. So when I am into an umbrella manufacturing unit, so in the rainy season and also in the summer season, the demand for umbrella shoots up. So starting from April mid till August end would be my peak season, right? So I'm talking about umbrella, say for an example, April, May, June, September, right? This could be my peak season. So normally I get to know from the peers or from my market survey in the area in which I am catering to, could be 100 units, 120 units, 140 units, 134 units, 150 units, and in September slightly less, and it goes down to 50, 60, 20, like this. Correct, either calendar year or financial year. So you can consider financial year also. Now, this is one aspect. I know my market size. This is my market size, right? This is my market size. Yes or no? Yes or no? So when I talk about market size means it's a demand from the entire market in which I am catering to, right? What is the next data I should look at? What is the next data I should look at to estimate my raw materials requirement? No, that is not the next set of data I will look for. No, neither the stock nor the raw material. No. You are jumping to 2 steps ahead. No. No, that is also not the data. No, labor cost also. How labor cost, labor capacity? No. Those will come at a later stage, Baba. I know the market size, the market demand. Which is the next data I should I should seek for? No. How come profit come here? How come profit come here? Think critically. Think you are the CEO and decision maker of your company. You have got the market data for the last 1 year. Correct, Manish. You are close to that. current supplier in the market and how much is the supply. Now the next data set is supply. So it is 80, 90, 90, 95, 98, 99, 100, 100, 100. This is the units which are supplied in the market. I'll get into competitor analysis after that, later on. So that is something which you are getting into micro level of analysis, which will come later. Now, what we are going to understand is demand supply gap. Demand supply gap. How we are going to calculate? Your market size, that is demand, minus your supply. Can you see there is a negative demand, negative in this months? That means if I produce, this will be unutilized in my go down. It won't be sold because demand is lesser than the number of units supplied. Now, why all of a sudden units of supplied increase? Because looking at the demand, some people has increased their production level and ready to supply it. At this stage, what happens? Credit. What happens is, what the sellers, what the shopkeepers ask for credit, discount, rebate, offer, delay in payment. That's it. This is a disputed zone. Where being a manufacturer, you get into a dispute with the sellers, your distributors. Because your product is not in demand, you are just trying to push it. Whereas supply is more than demand. It was not here. So up to this much is my green zone. Up to this much is my green zone. Right? This is my red zone. Yes or no? And if you carefully look, this is my orange zone. Where I should be a bit cautious. Why I should be cautious? Why I should be cautious here? Correct. So this is the graph which comes out. At this stage, I should be cautious. So initially it went up, then slightly down, and then slightly went up, then absolute fall. You can see the graph, right? You guys can see the graph, right? See, here I have to be cautious. Now you tell me. Now you tell me, what should I do at this stage? At this stage, and how do I plan my raw material accordingly? So when you are doing an analysis, you have to deep dive and be, work like a consultant, as if you are consulting the client. Client doesn't know anything. Reduce the production, correct. Reduce the production. I can increase my production here. Now, another thing is there, which we are missing. This data from April to December is quite an old data, right? We are looking at, so yesterday I told you why ratio analysis, we talked about limitations of ratio analysis, right? You remember? In this aspect, can you connect with something which I told you as a limitation of ratio analysis? Can you connect, guys? What is that limitation? Past data, correct. Past data, right. Now, April to December data I got for last financial year. Say I am assuming standing in 2023. Yes, it is historical analysis, Deepak. So I'm standing in 2023. I'm standing in 2023. I am looking at a data of 2022. I am considering the units and the market size which used to be in 2022. Right? Correct or not? What I'm missing is this year's intervening variables. What are the things that can act as an intervening variable for my umbrella business? Who are the new entrants in my locality who has also started a manufacturing unit? One. Next, who are the new dealers who has taken dealership of my competitors who are operating in a different location, but they have appointed dealers in my location. So this is an historical demand supply gap analysis. Additionally, what I need to do, I have to understand new supplier. Next is projected supply, which will consist of the existing suppliers and the new suppliers. Then I will be able to understand what will be my actual demand supply gap for the next year. So in the meantime, say there are 5 new suppliers or the new players who has entered into the market where I am playing. And there is additional supply of say 10 units every month. Demand has, I assume it remains same. Now, the actual demand supply gap is right. Correct me if I'm wrong. Is it right or wrong? Does this make sense? Right. Now this is for the year 2023. Right. But am I starting a business only for a year? Am I setting up a manufacturing unit only for a year? At least for 5 years. Then what I need to do? Right? Tell me, do I need these figures or not? At least for 5 years, for an example. Then probably umbrella will get replaced by something else. Some new technology, like the way the old mobile phone is done, Android phone is there. Now iPhone is there. Now skin inserted phone will come. Very soon you will have a phone which will be inserted within the skin. Right? Now I need this demand supply gap data for another 5 years. How do I get that? How do I get this data? This is my question to all of you. Good. Projection by analysts or management consultants. True. Second, you can extrapolate the data provided you correctly identify the variables. Again, historical data will give you a trend that is true, but the trend can be changed. Nobody could even assume there will be something called COVID for which railway will be stopped for 6 months. I think more than 6 months. So even if you do a 10% increase of this figure, right, that might not be correct. Could be 20% increase of this demand supply gap. Could be more than that. Could be a 20% drop in demand supply gap. Right? Right? Industry analysis, true. Peer-to-peer analysis, true. Market research, true. R&D expense, true. Another thing is called news. Government policies. Right? Government policies makes does it affect your demand supply? It does, right? Right? So these are the estimations for overall viability of the project for at least 5 years. First of all, NPV IRR is definitely a major, inevitable, important portion of your analysis. But when it comes to understanding the project viability, and when you talk to the promoters as a credit underwriter, and when you are going to sanction X amount, and it could be in crores, then you need to understand your customer is having proper clarity for future or not, that what would be the demand supply gap for next 5 years, considering the seasonal factor in mind, considering the cyclicality of the business in mind. Correct me if I'm wrong. Correct me if I'm wrong. You will ask, na? Next 5 years, may what is going to be the deal? And this amount, this demand supply gap is going to determine your future projected financials. So if I am selling 10 units at the rate of 500, then probably in April 2024, this is going to be my revenue. Right or wrong? Right or wrong? No, it's wrong. You are saying correct, but I am saying it is partially correct, not fully correct. Please tell me why it is not fully correct. Please tell me why it is not fully correct. There are 2-3 parameters here which you are ignoring. Don't get into that much criticality, future value of money and all these things. No. Think very simple. Think very simple. Think, tell me. If you understand this, I'll tell you, your project finance will be on your fingertips. Deepak, you are quite close to it, but I need the specific answer. What I'm asking is, if this is the unit, this number of unit is the demand supply gap as on April 2024, then considering 500 rupees per unit, this will be my revenue for April 2024. Is this correct or not? Can I find out my revenue similarly for 2027 April? No. Why no? Can I use the same technique across all the months till 20? So price increase or decrease is one part, right, Yashwant? Actual gap will be different. Why? Because here I am not considering one important thing, that probable new entrants. This is an extremely important point. I have to understand what would be the, or how many numbers of probable new entrants would be there in 2025, 2026, up to 2027. And I have to factor all this. And more number of entrants means there is a push in the supply, which will reduce demand and price. When the price is getting reduced, my revenue will reduce. Even if it is increased, then obviously my profitability is going to get hit. So to understand my net profit, which will further give me cash flow, I need to factor all these things. Am I correct or not? Price will change, definitely. If there are a lot of suppliers, price will drop. Price is bound to drop if there is a lot of suppliers. So do you think anybody will purchase at this point, this red zone? Your supply is more than your demand. Correct. This is another question, how to get data. So there are market research agencies not the conventional research, who conducts a survey, right? They observe a trend across all the industries and at least can give you a hint. And if not, you can consider a thumb estimation. So when I called up as a thumb estimation, that say, you know, this many number of players are operating, or this is my supply. Every year, you do a 20% increase of this. So this is for 2023, 2022. For 2023, probably my supply figures will increase by 20%. Okay? Ignore the decimals, right? Again, for 2024, another 20%. Again, ignore the decimals, right? So if you are not getting a data, probably you can use a thumb rule and increase the number. Yeah, 20% of previous year or base year. So not the base year of previous year, not the base year. Base year 20%, if you calculate, it will remain same. You consider that it is increasing. So you are on a much more conservative mode. Then your calculation will be more correct. So if I consider only 20% of the base year, you will keep on adding 16. But here, the difference is 16. So if you calculate this 96 minus 80 is 16, whereas this is more than 16. This is more than 16, this comes 19. And this gap will increase on a year-on-year basis. So not best year, consider it on the based on the previous year. Then you are on a much conservative mode. Your calculation is much more correct, conservative, and then probably you get a correct estimation, right? If the situation is near to reality or in positive or negative sense, both way. If it is more than 20%, then obviously negative sense. If the increase is less than 20%, you will have your hay time. Got it? So based on this, when you are estimating your projected revenue and your projected expenses, this is one part of the calculation, that is your revenue. Then what is your projected expenses? That is something again you have to calculate. There are many factors which you need to consider, like one is your labor. Then again, halt of productions due to unknown reason, due to many reasons. Then there is seasonality. Could be in the monsoon, you suffer a heavy loss because of water and all these things. Then it could be strike. It could be discount. It could be donation to political parties. Kamlesh, market size will also increase. That also you have to estimate. That also you have to estimate whether market size will really increase or not. Market size will increase only if there is no substitute. If a substitute is there, market size will not increase. If this kind of estimation would have done by Hindustan Motors, then probably ambassador looks would have been different. and Hindustan Motor would have been operational. They were very lenient, thinking that my ambassador car is best and it will never go out of market. Yes, alternate products. Alternate products. Okay. So these are the typical, factors which you have to keep in mind while you are calculating your costs. So now what we have spoken about, Durga Prasad, you are right. There is no alternate to gold till date, and gold is a very good investment. So I would say land and gold are more than land, gold is a very good investment. In case of emergency, one can go to Muthoot Finance or Manappuram Finance to get a loan on gold. That is quite possible. That's a good investment. Okay. Now, these are the typical costs which will consider when we do estimate project. Now, coming to raw materials, the discussion from where we started is how to estimate my raw materials? Yes, on the demand supply basis. Now, how much raw materials and how much working capital requirement should I keep? Raw material, manpower, these are the two major factors, right? And what is the credit period in the market? Now, if my raw materials cost is say 60,000 for 1 month, and my manpower cost is say 90,000 per month, and my other expenses like electricity, these that are around 30,000 per month. So per month my variable expenses are 1,80,000, right? And in market, I have to give credit for 3 months. Is 3 months. So how much provision I should keep? How much provision I should keep for my working capital? Hi. Am I audible? Consider you are not getting anything on credit. Consider, so my question is, these are my expenses per month, right? These are my variable expense per month. And I have to give credit in the market for 3 months. Yes, Yashwant, you are correct. So we have to keep a working capital of 3 months. Sorry. We have to keep this much amount of working capital, right? Plus interest cost. Yes. Now, is this the amount which I will keep as working capital and nothing else? And nothing else. This is a minimum one. Add 20 more percent to it. Add 20 more percent to it. And keep this as your working capital. Always you should keep some buffer. Yeah, because you never know about the contingency. You know it is 90 days. But if somehow you don't get your money back within 90 days, then if you don't get your money within 90 days, then what? You have to, can you stop business? Can you stop business? Then you have to borrow. Then you have to pay borrowing cost as well. Okay. Yes, or go bankrupt since no fund is left. So based on this, so it is difficult, but that is something which everybody is doing, and that is something which you have to do. Ideally, if it is a high ticket size funding, is going beyond 1 CR at least, then ideally, as a credit analyst, you have to deep down and understand whether this kind of clarity is there or not. So I'll tell you, there was a guy who came to me. He was looking for 30 CR funding because he wanted to open a chain of apparels, clothing stores. So he wanted to open around 10 odd clothing stores on rental basis, and he needed 30 CR of funding. I said, fair enough, sir. You give me your projected financials and clarity on that. He gave me his SWOT analysis. I said, fair enough. You have given your SWOT analysis, which is a global Gyan kind of thing. Everybody understands what is strength, weakness, opportunity, threats. You give me your projected financials. So he gave me his projected financials. And the projected financials, when I looked at, it was so unrealistic, you won't believe. It was so unrealistic. Like at this presently in this market, he is claiming 200, 300% growth on a year-on-year basis for next 10 years from the same store. Now, what extra he is going to do in a clothing or apparel store for which he is going to get 200% extra? That I asked him. That's I say, sir, fair enough. I understand that you are going to get 200% growth, 300% growth in your top line and also in the bottom line. The strange thing is that. But tell me, what is going to be your strategy for which you are going to get a 200% growth? How you can assume that? He got irritated. He literally got angry. He said, you don't need to look into my proposal. I said, fair enough, sir. You're most welcome. Thanks for your time, and thanks for the time you have taken out for me, and nice interacting with you. So there is nothing called maybe, Abhijit. He could not answer that. When I am putting some figures on pen and paper, then I should be very confident on that. If I am not confident, then I will not put those figures on pen and paper. Correct me if I am wrong. So till now, for almost 1 hour, 10 minutes, we have been talking about demand supply gap analysis. Do you think how much practical or impractical this calculation is, what we have done till now? The one which I have shown you, is it practical or this is impractical? Am I talking about a 20% growth in revenue? 200% growth in revenue, 300% growth in bottom line? I'm not talking about it. Rather, I'm becoming very conservative and putting it in pen and paper. And if I really make a project report and go to a place called Shark Tank, I should be able to tell them, make them convinced with my facts and figures. And it will be more convincing if I can really show them that this is the industry figure which is available in open source, or this is the genuine and credible source from where I have got this data. Right? So this much deep dive you have to do, just not doing a NPV is positive or NPV is negative. No, that will not work. That will really not. You can work as a consultant. Now, when I talk about the major capex, right? How you can reduce capex? Now, as a consultant, if there is anyone who is consulting the customers for getting finance, anyone here who is consulting the customer for getting loans, either it is in the form of debt or private equity, venture capital. Anybody here? Okay, Yashwant, you are planning to start consulting. Great. Okay. So now think 1% me. I don't have all these detailed understanding and go to the customer, sir. You are setting up a project. Please give me a chance. I will get finance for you. This is one approach. Sir, please give me chance. I will take 2% of the entire funding amount, or I will be getting some payout from the bank or the financial institute. This is one approach. Sir, I will give you some discount. Sir, I will get you an insurance policy at a lower cost, lower premium. Sir, I will pay your first year's insurance premium from my pocket. Sir, give me the deal. I will get the deal through SBI or PNB. This is one approach. The second approach, Yashwant is going to a customer. Yeah, I'm coming to that, Yashwant. And you are working as a consultant and you are literally guiding the customer like the one you have just said, take it on rent for a certain period from an existing player in the market and see how the market behaves. So you don't need to go for huge capex. You take it on rent and then you start the business. This is a consultative approach. Now, when you are saying that there can be resistance from a customer that why you are asking me to take it on rent? Why should I take it on rent? I have money I can invest. Then if you know all these details and you can present it properly in front of a customer, then obviously a customer will get convinced. Not only he will get convinced, but he will have a respect for you. Isn't it? He will have a respect for you. He will listen to what you are saying. Because he will respect your knowledge, your guidance. Am I correct or wrong? Even as a credit manager, if you guide a customer like this, he will respect you. He will not call the sales guy. He will not call anybody. He will not call your boss. He will call you time and again whenever he requires finance. Even if you are not in that company, he will call you. Sir, you have left that company. Tell me in which company you are. I will go and take finance from you. He will not mind shelling out 25 basis point more rate of interest because you are there. Trust me, this happens in the industry. This is from my personal experience, I'm telling you. So one point is guide him to reduce the capex one way. So how this capex is coming from? When I talk about plant and machinery, I can either use my equity or use a debt, right? I can purchase plant and machinery of 200 CR either by my equity or my debt. I can raise a debt fund, right? Right or wrong? Right or wrong? Okay. Now, what is the tax implications for investing this money in equity and debt? What is the tax implications? I have to increase the profitability of the company. What is the tax implication? Tax implication when I take debt and when I take equity. Interest. So if I go for debt, the interest portion will be tax free, right? Interest portion will be tax free. Nothing in equity. So you can suggest a customer that you take debt and save interest on your taxes, right? Is there any third option by which he can save more tax? Is there any third option by which you can save more tax? Subsidy is one portion, that is different. I am saying about plant and machinery. When I talk about plant and machinery, please stick to plant and machinery. There are two options of procuring plant and machinery. Either you procure by using your equity or you procure by raising a debt. What is the third way which can save more tax? Rent means leasing. Yes. Leasing. How leasing is going to save tax? So taking the machineries on lease, how it is going to save more tax? And how it will make it more profitable to me? Please answer, guys. So there are two benefits. One is this lease rental will always be more than your EMI. So if you are paying an EMI of say 100, lease rental will be 110, right? And in 100, sorry, in out of 100, probably 70 is the amount. Yashwant, I'm coming to that. Let me finish first. Okay. 70 is the amount of interest. Out of 100 EMI, 70 is the amount of interest. Right or wrong? Okay. In lease rental, so you will get tax rebate on 70, right? You will get tax rebate on 70, yes or no? Lease rental, this entire 110 is debited to PL account. Entire lease rental amount is debited to profit and loss account. So your net profit is getting reduced by 110. So the entire amount is tax free. This is the benefit of lease rental. No, how can you capitalize lease rental? You cannot capitalize lease rental, Bharat. It is lease rental. It's an expense. Are lease rental का कैसे principal? What is principal portion in lease rental? It's an expense for you. Out of 170 is interest. I understand. So 70 is tax free. I am talking about saving tax. But where is 110 which rental you are paying? Entire 110 you are debiting from PL account. See, your entire net profit is coming down. Taxable income is coming down. You understood, Bharat? I understand, Bharat. Like I'm not able to unmute you. Okay. You can send me a mail if you have some questions like this. Anybody, abhijit.stfc@, or else you can send your queries to Equalify. I'm giving you my mail ID, but you can send your queries to Equalify as well. Achha, somebody was asking my LinkedIn profile, right? You search by this name, ABHHIJIT. ABHHIJIT, Abhijit Chatterjee. ABHHIJIT. You can search me by this name. Let me see if I can unmute you guys. Who wants to speak? Bharat, right? No, I'm not able to. I'm not able to. Okay, I will accept.
Hello.
Yeah, Bharat.
Can you hear me, sir? Hello, sir. Yeah, good to speak to you, sir.
Yeah, please.
So when you say the lease rental, so that includes the interest component and the principal component. So that's my understanding. So I thought the principal component will be capitalized and only the interest portion will be taken as expense to a P&L account.
Only interest portion will be taken to P&L account, and that is becoming tax free, right?
Yes, that is becoming tax free, but not the entire 100 rupees or 110 rupees.
110, again, you are making there is a gap in understanding, Bharat. Please understand. 110 rupees is for lease rental, not for the EMI. Your EMI is 100 rupees. If you see, I have written it clearly. EMI is 100 rupees. Lease rental is 110 rupees. Lease rental, you cannot break up into principal and interest, boss. You can break up EMI into principal and interest. How can you break up lease rental into principal and interest? Tell me. Can you break up lease rental into principal and interest? You cannot. Lease rental, what you have taken on rent. See, if I have taken rent from Fuld & Co. for furnitures, how can I break it into principal and interest? I have to pay a lease rental of 3,000 rupees for a dining table. That's it. How can I break it into interest?
Sir, actually, as per the Ind AS accounting standards, okay, we are supposed to find out how much is out of the lease rental, how much is the portion which is a finance cost, and how much is the principal component.
Sir, finance cost comes. See, Bharat, listen, understand the basic difference between. You need to understand what is the basic difference between lease and finance. I cannot make you understand if you don't understand the difference between finance and lease rental. Lease rental means you are taking that machineries on lease.
Yes, sir.
You are not getting it on finance. This is not owned by you, right? I am not owning the machine. I am taking it on a rent. It is very similar to house rent we are paying every month in full. Now, house rent, you can take a tax-free claim. That is a different aspect. Let us not get into that. But when I am paying lease rental for a machine I have taken on hire, I am not giving EMI. I am giving lease rental.
Yeah. I can understand that, sir. But I remember reading like this, so that is why I raised the question.
No. That doesn't happen. You can ask to anyone.
Okay.
You can ask it to anyone.
Okay, sir. All right, sir. And I have just put the link, sir. Okay, I just tried to Google that again in online. Okay,
Yeah,
where
please do
they're
that.
saying that in that Ind AS 116, the lease account lease treatment, we are supposed to split like this and then account it in our books, sir. So they are telling that
How
you
can
have.
you tell me a logic? How can you please
Sir,
understand the logic? How can you come? See,
I
when I am
I
not
will tell
paying
you, sir.
interest.
No, no, I will tell you, sir. See, in a lease accounting, when you take something on a lease, they'll tell you like you're taking it for 10 years, 15 years. Okay. Hence, we need to assume that there is there's a certain rate of interest which is being inbuilt in that. And then we'll have to split that 1 lakh or 2 lakh lease rental which we pay
No, you cannot
into.
assume like that.
Okay.
You cannot assume like that.
Okay, sir. Okay, sir. Okay.
Okay.
Okay, sir. Yeah, no problem. Yeah.
Okay. So this is one consulting you can give. Second thing is that you can, as a consultant, you can work and find out how you can reduce the expenses so that your cash flow goes up. Right? So this is about NPV. This is a typical method by which present value is getting calculated on a year-on-year basis. And you get the terminal value and you find out the present value of the investment. Just an illustration. Next is IRR. Now, what is the difference between IRR and NPV? The internal rate of return is a financial metric used to evaluate the profitability of an investment or a project. So if IRR is positive, the investment makes sense. If IRR is 0 or negative, then the investment doesn't make any sense. So if the discount rate at which the NPV of the investment becomes 0. In the other words, it is the interest rate at which the present value of the investment's cash inflow equals to the present value of the cash outflow. So NPV, the entire present value of the cash inflow has to be equal to the present value of the cash outflow. That is the concept of IRR. This is a typical formula of IRR where there are two discounting rates which are given. So you can take a snipping tools of this because we will do a bit of exercise after this. We'll do a bit of exercise. Please take a snip of this. Rajesh, fees for the consultant depends. Like it is normally around 2%, 3%, depending on the project. Guys, have you taken snipping? Snip? Yes, it depends on consultant success rate as well. Consultants' knowledge, success rate connects with the banks, connects with the private equity players and the venture capitalists. How many projects he has successfully got funding. So all these things matters. So, okay, guys, have you taken snip of this? Everyone? So there are two discount rate. One is lower discount rate, another is higher discount rate. So this is the formula for the entire cash inflow for a project. We'll have to find out an NPV for with a lower discount rate and NPV for higher discount rate. Okay. So there is a small mistake here. RB is the higher discount rate and RA is the lower discount rate. So here at this portion, both RA is coming. So consider second one is RB. Rajesh, as such, there is no qualification. This is a kind of investment banking which requires mainly your connects with the bankers and connects with the customers. So you work like a liaison kind of profile. So you need to know the basic financials. It's better you become a knowledgeable. Many chartered accountants are working and even non-chartered accountants, MBA, BCom graduates are also working. CFAs are also working, right? So it's not that something, a basic qualification you need, but yes, definitely you need to have knowledge, and more than knowledge, you need to have connections, connect with the customers, right? So these are some inputs for the project data, network data are all the inputs, and the financial viability evaluation framework consists my demand estimation module, what we had discussed, payment performance module, how my payment will come, what would be the credit period, what would be the cyclicality of the payment, cash flow determinant calculation model. That is the reason for which we have been calculating, doing a thorough brainstorming. What would be my profitability? What would be my top line, bottom line? What would be my cash flow on a month-on-month basis and year-on-year basis? So this way we will have to estimate. So estimation correctly is extremely important. Performance metrics using calculation models. So you can use a number of models, like you can estimation models and all these to understand your demand supply gap analysis and all. And the decision output is your financial indicators, your economic efficiency measures. When I talk about financial indicators, what are the typical ratios that you could have, say 4 years down the line? What could be the efficiency ratios you will have in the project? 4 years, 5 years down the line, based on which you decide whether to go ahead or not, apart from your NPV and IRR calculation. These are typical advantages of NPV, which is simple to use. It provides time value of money. You can customize it, determines investment value. It is comparable from project to project, sector to sector, area to area. Comprehensive method, yes, it is quite comprehensive method because it is inclusive of everything, your financials, cash flow, everything. It measures profitability, it identifies risk. It is again having a reinvestment of assumption. So the cash flow which you are getting, the another second aspect is when I talk about payment performance module, एक second, yeah, 1 second. Payment performance module is how frequently I'm going to get my payment, right? So now there could be another assumption is, so where I have estimated that my cash flow would be say 70,000, 80,000, 95,000 and 1 lakh for the next 4 years. Year 1, 2, 3, 4. But out of which, whatever profit I am getting, that can be reinvested in the project. So there is a scope of doing that also in NPV. Reinvestment. So retained earnings, which is further reinvested into the business, that provision is also there. So here it is for, here we are calling that reinvestment assumption. It's not formula, it's simple. See, don't go by formula everything, boss. Say you are earning 10,000 in this year, right? This again you are reinvesting. You easily can calculate. Now at this fourth step, again there is a cash outflow of 10,000, right? IRR formula I will explain. Okay, sure, definitely. I will explain this formula. Let me check if I can quickly have a board download where I can type on. It will take some time. But anyway, I can express in Excel as well. I will, for the time being, express in Excel. So this is the formula of IRR, right? Now I will show it in Excel. There is something called lower discount rate, RRA, lower discount rate. Say this is 5%. Next one is RB, which is higher discount rate. Say it is 7%. Next is NPVA. What does it mean? What does it mean? NPVA means what does it mean? NPV at a lower discount rate, correct? Similarly, right, NPV at a lower discount rate, right? Similarly, NPVB, so NPV at a higher discount rate, right? Higher discount rate, correct? Now, knowing these cash flows, say I'm considering 5th year also, that is 1,10,000, right? Can I calculate NPVA and NPVB when I know my RA is 5%, RB is 7%? Can I do that? Can I do that? Yes, no? Yes. Please calculate NPVA and NPVB and write down. This is your cash flow on year-on-year basis. Calculate NPVA and NPVB. Yashwant, you can use the formula as well, because it will save some time. Now you can use the formula. So I can, right? Correct. Now NPVA, how much you got? Okay, so NPVA is 389,751. Which one is NPVA? Let me check. Yeah, this is NPVA. And NPVB is, this should be 367. Yeah. Now tell me, now go back to the formula of IRR. I know RA, I know NPVA, I know RB, I know NPVB. Now find out the IRR. Now find out the IRR. I know RA, RB, NPVA, NPVB. I know the formula. Just put the figures and find out the second part. How means? You have to just put the figure and find out the IRR. It's very simple, Bharat. So do one thing. To ease your calculation, you first calculate the numerator. NPVA into RB minus RE, right? So when I talk about NPVA, this is my NPVA into RB minus RA, right? Right? This is what I got, the numerator. This is the numerator. Then what is the denominator? NPVA minus NPVB, right? NPVA minus NPVB. This is my denominator, right? So let me see, it will come in fraction. This numerator by denominator will come in fraction, right? 0.351. What is my RA? My RA is 5%. My RA is 5%. Now, no, this has to be in not in percentage, but a general number. So your IRR is becoming 40%. No, actually not, because 5.35% will not come, because this is 0.35 means if you convert it, it will become 35% actually. Should not be so high. I don't understand why it is becoming so high. 1 second. Yes, exactly. I am understanding this. Just okay. I have already calculated the percentage, right? I have calculated in the percentage. Yes, it is 0.35%. Correct. Then it is 5.35%. Ah, shit, yeah. It is 5.35%. Correct. It is 5.35%. Right. So this is your IRR. Now the concept is clear. Clear to everyone how to calculate IRR? So now the formula is very much clear. Now it is in your fingertips. You can calculate IRR. However, in real life, IRR we calculate in Excel in a different way. All right. Next is there are certain disadvantages of NPV method. What are those? It is difficult to estimate the expected cash flows from a project because you estimate something, something else happens. Discount rate is also very difficult to find out. Since this method does not consider the life of the project, in case of mutually exclusive project with different life, the NPV rule tends to be biased in favor of the long-term projects. So what does this mean? So why the NPV rule tends to be biased in favor of the longer-term project? Anyone, please tell me. Why the NPV rule tends to be biased in favor of the longer-term project? Why? Correct. It is because of more cash flows. It is because of more cash flows, higher cash flow, right? So if this I continue for 15 years, then obviously my present value will be more because higher number of cash flows. That's it. Since NPV is expressed in absolute terms rather than relative terms, it does not consider the scale of investment. So basically, we consider it in terms of relative terms. What is my investment versus my cash inflow? So it is mostly in relative terms. So what scale of investment is there, that doesn't come out with that. There are few advantages and disadvantages of IRR method. It considers time value of money is the advantage. It determines exact rate of return, also is an advantage. Easy to make selection decision, understood, and focus on profitability. And the disadvantage is it is a complex technique. Even the calculation is slightly complex, as you have seen, and not suitable to compare between mutually exclusive projects. So that is also one thing. Yeah, so there is a question, Yashwant, that which method is better, NPV or IRR? So generally IRR method is better, and that's why in any kind of project or term loan method, IRR is the only thing which is considered. NPV is not considered anywhere in real life scenario. Okay, guys, this is a quick activity. You can see the figures. Quickly calculate NPV and IRR. I have given the different discounting rate. So find out the cash flow and find out the NPV and IRR. 10 minutes time. Quickly do it. Done? Done with the exercise? .09% is the IRR you got, Bharat. Okay. What about others? What about others? Guys, what about others? It's an exercise. I have to calculate, Bharat. I've left it to you. I have not yet calculated. I have to calculate. So if all the answers comes same, then obviously I will assume that yes, it is done correctly. So that's why I'm asking everyone to answer, please. Calculating NPV is very easy. Just put it in formula and calculate it. That's it. It should not take so much of time. You have to calculate NPVA, NPVB, but that's then put it in formula. You know RARB. I don't understand why it's taking so much of time. What's the answer, guys? What about others? It's 5.09% for Bharat. What about others? Everyone seems to be quite tired after a Saturday night. Everybody had gone for a party yesterday, it seems, right? How many of you had gone for party? Saturday night party? Almost everybody, it seems. At least the 19 people who are there in the room now. They all have partied till late night and doesn't want to brainstorm. No party. Then give the answer. Then answer, please. I had given you a task. You all guys were given a task yesterday. Nobody has done it. So what should I assume? They were in the party on Saturday evening. Okay. So Yashwant, you will get a recorded version on the portal. Just connect with Equalify. They will upload because all these training sessions are getting recorded. So they're going to upload it in the portal. So when it will be uploaded and that you get to know from Equalify. Okay, guys, let us wrap up today. Thanks a lot for your participation. Okay. Hope you enjoyed the training of NPV IRR project funding and also on the retail underwriting portion. Okay. Thanks. Bye, everyone. Thank you. Thank you. Thank you. Thanks. Bye.